I'd like to welcome our new sponsor, Rothschild Capital Solutions. Rothschild is a commercial investment banker and direct lender. The company targets well located assets for value add investment primarily in the Midwest and the Southeast. Rothschild is positioned to invest up to $35 million per deal. They may be just the partner or lender you've been looking for to turn your deals, even the most aspiring, into reality. Need capitalization beyond a debt financing loan? Rothschild gives you a full set of options: JV equity, bridge, preferred equity, mezzanine, development and construction. What do you need? The chances are Rothschild can provide it, as well as the experts to make the deal real. Click on the banner below the show to contact Gary Williams now. You've got the deal, Gary's got the backing you need. Click now.
Hello, and welcome back to another exciting edition of Money Talks. I'm your host, Michael Thomas. I'm very excited today. I've got Bob Hutchins with me from Ellavoz. Ellavoz is an impact funder, impact with a capital I. They have opportunity zone investments. They also have non-opportunity zone investments, but they all are impact focused, which I absolutely love. Bob, thanks for coming on the show and welcome.
Mike, thank you so much for having me on Money Talks.
My pleasure. My pleasure. So before we jump into the really interesting and cool work you're doing in Ellavoz, could you just give us a little bit of your background and what got you into impact investing?
Certainly. I spent most of my professional career as a partner, tax partner in a CPA firm, where I worked with high net worth individuals and complex tax structured transactional deals. I was also entrepreneurial in my career and involved in founding bioinformatics companies, healthcare, mobile healthcare, and restaurant, some hospitality. So I've had an entrepreneurial background for almost since I got out of college. I also had a social entrepreneurship background where I founded two charities. One is special needs housing. It's low income, seriously mentally ill adults. We have a 48-bed residential healthcare facility. And I founded that back in 1993. We have supportive housing that we've added to that charity, and I'm very proud of it. It was my first entree into trying to finance and develop special needs housing. I recognized pretty quickly how difficult it was. As I began to wrap up my public accounting career, I decided that my next gig would be to create a social impact private equity firm that would provide a vehicle for high net worth individuals who wanted to positively and directly invest in social impact community development, a way to do that.
That's great. That's fantastic. And congratulations on the special needs housing. As a HUD lender myself, I occasionally get requests that involve that type of housing, which is it is a difficult type of housing to finance. That mental health, detox facilities, things like that are very much needed. And in fact, some people have been talking about using impact capital to invest in those in opportunity zones and elsewhere. So it's great to hear that you have a background in that. So we had talked briefly about Ellavoz and what you're doing that's different. One of the terms that we hear a lot with impact investing is ESG, environmental social governance. And, there's not really anything very assignable, I guess, to that terminology. There certainly is a feel-good aspect of, I'm doing something that is quote unquote good. But tell me how your approach at Ellavoz to making a difference in impact investing, how did you approach that in terms of, the quantitative and qualitative metrics?
Certainly. I looked at this really from the beginning, and I've read and studied back to socially responsible investments, which was more of a marketing kind of program. ESG, very familiar with. In fact, in my former profession, ESG was defined as a risk assessment tool. And really that's what it is. Environmental is certainly a risk in any business transaction, and that's clearly understood. Social didn't get much attention under the ESG rules. Governance was a little hard to comprehend. So most people think of ESG as more of an environmental and very little on social or governance. When we get to true direct impact, social impact, the S becomes a capital S. And we use direct social impact, positive social impact as our definition of identifying a problem, going in, solving the problem, and then finding the investors who want to finance the solution. Mm-hmm. And that's what we're all about, really, is actually getting things done. My background allowed me to a significant knowledge of how the system works within the government incentives, both from financing and for tax purposes, such as opportunity zones under Section 1400Z2 of the Tax Cut and Jobs Act of 17. There's also significant community development grants, block grants, historic tax credits, new market tax credits. Government puts out a considerable amount of incentives for this kind of distressed community redevelopment. Unfortunately, very few individuals are aware of them or want to work in that sector, other than just some nonprofits. We're a little unique. We actually partnered with two nonprofits in putting together our social impact private equity firm. One partner is a community development financing institution, which is a not-for-profit bank specializing in financing on a debt side the distressed community development. Our other partner is Community Asset Preservation Corporation, which is one of the larger not-for-profit affordable housing developers in the East Coast. And they are mission-driven organizations, well-funded, as well as having very, very strong management team for executing on their mission. We're providing the financial capital to scale the amount of good that they can do in these communities. And I provide the tax and transactional expertise here at Ellavoz to be a seamless transaction. We're transparent, we're low fees, and it is a new asset class for accredited investors to directly change the future of America.
Yeah, that's fantastic. So to summarize for our viewers, try and put it just in layman's terms, it sounds like what you're doing is you've got a partner that's a nonprofit, a CDFI, and they're going out and you're targeting something, whether it's in a qualified census tract or an opportunity zone or some federally designated, area that's underserved. You're targeting that, and then you on your end, you're bringing in the private equity, the private investor dollars, and you're helping all the I's get dotted and T's get crossed, so to speak, so that they are, pretty sure they're going to get that credit, right? That tax credit, which is their benefit, if you will, of their investment dollars. Is that right?
Absolutely. I'm providing the expertise in putting all of this together so that the investment returns for the investor are comparable in the marketplace. In addition to our very stringent social impact criteria in measuring the feasibility of projects that we go into. We are very committed to doing projects that are in fact social impact. We're not interested in doing luxury hotels. We do primarily affordable housing, mixed use. We look for things that have economic development benefit. We have three means to measure impact. So we're very careful that our investors are social impact investors, and we're very careful to see that not only is their money invested wisely from a financial standpoint, but it is invested directly in the types of social impact that they wish to make a difference in. It's legacy investing.
Yep. No, that's fantastic. So it sounds like you're taking it a step beyond the geo target of the underserved community, and then you're doing an additional analytical process on it to make sure that it's a true impact investment, which is one of the criticisms opportunity zones received at first, because if you were located in an opportunity zone, you virtually could build anything there, and that would be considered a opportunity zone investment. Is that right?
That's correct. And when shortly after the act was, the new tax law was enacted, we saw some less than prudent actors doing deals that didn't really meet the spirit of the law. That's been cleaned out now, really, because those developers have not really succeeded too much. A few have, but more than not, it hasn't been successful development.
Mm-hmm.
The opportunity fund managers like us now are really looking at more social impact viability. We measure social impact three ways. And it has to pass our social impact criteria before we go in and start doing due diligence, feasibility, and investment structuring and valuation. So, for instance, we won't look at a project that isn't at least 51% affordable housing. That's our focus.
Okay, that's great. That's fantastic. I love to hear that. So let's talk about dollars here for a second. The show is called Money Talk, so we definitely need to talk about money a little bit. You had a published number of what you would raise, but I'd like to know kind of what you've raised, what you're hoping to raise, and then how big you think the market is. Before you answer that, let me just throw out there, you and I talked about some pretty big numbers, and then I did some more research. And I guess depending on, whose research is going to be correct, there's clearly trillions of dollars, not billions. Is that correct?
Absolutely. There's about $70 trillion just here in the US in portfolios of individuals that qualify as accredited investors. If just 5% of those portfolios invested in positive social impact investments, that would be $3.5 trillion, which is leveraged to well over $10 trillion of infrastructure. And think of all the jobs that could be created with $10 trillion of construction and development in distressed areas. We walk these areas, and we particularly enjoy remodeling and renovation of beautiful buildings that have been left vacant for sometimes over a decade.
Yep.
There's such great infrastructure out there that's not being used, and if we could somehow we have a 5% pledge, which is kind of our motto, that if everyone allocated 5% of their portfolio to social impact, that would be $3.5 trillion. And in a typical deal with some financing and tax credits and grants that are all part of the capital stack in our typical deals, 3.5 trillion is well over $10 trillion of affordable housing, economic development, healthcare centers, childcare centers, etc.
Yeah, clearly a huge opportunity there. I mean, if you had to just sort of guess really on how much of that is institutional or Wall Street type accredited investors, or how much might be like mom and pop? What do you think that would be?
I don't have those statistics, to be honest. Um, there's a lot of money on the sidelines. If you follow the private equity industry right now, there's trillions of dollars sitting around with no place to go. Um, a lot of people think the stock market's fully priced out. There's a lot of what the PE or private equity market calls dry powder out there.
Yeah.
And I recently, within the last couple of years, sold a bioinformatics company that I co-founded with a doctor out of Johns Hopkins University to a New York Stock Exchange company. And the valuations over the last couple of years have been extremely high because there's more money chasing less deals.
Right.
How long that can last, I don't know. We are in the opposite side. You know, there's 10 people looking for affordable housing for every 1 unit that's available. And that shortage is only going to get worse.
Yep.
We acquire our inventory or portfolio of community properties at significant discounts to market through our not-for-profit partners. So we're able to scale even more because our capital is so valuable to these projects to get them done.
Yeah, I'm glad you mentioned that, because it really is quite different than how the traditional non-affordable or non-impact markets work, right? You're typically buying stuff that nobody is bidding on, right? Because there's some kind of a problem, or it's dilapidated, or maybe there's environmental issues or something like that. So, you're not so much getting bid up in a bidding war on properties as much as you just have a lot of heavy lifting to do your actual work on it. Is that right? Is that fair to say?
Michael, you're absolutely right. There's a lot of work. There's a long runway to get from the time we walk communities and meet the neighborhoods and the neighbors and talk to the community leaders and other stakeholders to the time when we'll hopefully get to cut the ribbon. So it is a heavy lift. It is a very technical lift because there's a lot of moving parts, complex structures, a lot of pieces to the puzzle. We are fortunate. We have figured out how the puzzle works, and along with our partners have put the puzzle together. And so we're executing on that. We finished up our first deal in Newark. It was the former St. Michael's Hospital, which we converted into 3 floors of workforce housing that'll serve the health aides and workers in the new St. Michael's Hospital across the street. We're very proud of that. Particularly during the pandemic, we're providing a very attractive living space for our essential workers that everyone is so proud of, and they continue to do a Herculean job. On the bottom floors, we have a glass blowing factory, glass blowing educational facilities, a coffee shops, artist studios. So it'll feed the cultural needs of that community as well as the housing needs. In all our projects, we like to have what we call resident amenities. Those amenities could be a child care facility on the first floor that we will provide free of rent to a not-for-profit that in the neighborhood that we partner with.
Yeah, I love that. I mean, I'm a big fan of what you're doing there, because I talk a lot about workforce housing on some of my shows. And, one of the big challenges too is services and what can you do to help people move through the income band, which is really the idea, help people to grow and thrive in that community. And that sounds like one great way to do that is to approach that sort of educational tutoring type of a way. Job skills I've talked about, some retraining. I mean, if we truly have lost, like they're saying, that we've lost some of these retail or restaurant jobs, maybe indefinitely, there's going to be some retraining. So big opportunity there. Can you share with us what the dollar amount of that was and what you're hoping to raise for your next fund?
Well, we closed two small funds, two small investments. They were single asset funds that were oversubscribed during the pandemic. And because of the pandemic, we pushed our launch of our funds 3 and 4 until actually this month. Our raise we have 2 new funds coming out. Fund 3 is our third opportunity zone fund. It will be a multi-asset fund, and we will be targeting 17 communities in New Jersey and 4 communities in Florida for redevelopment. Fund 4 is just a pure social impact fund. In that, you will not have the tax benefits of an opportunity zone fund, but you also don't have the 10-year hold period that you need to obtain those tax exclusions on the gain of your investment. So that'll have a 3-year hold. Unlike any other opportunity fund manager, we are not transactionary. We are strategic. So in launching 2 funds, 2 different funds with the same purpose at the same time, we are strategically targeting 21, actually more than that, but at least 21 communities where we will, in Fund 3, acquire, rehab or construct, and hold for rental, affordable rental, for 10 years. In Fund 4, those same communities that have been targeted strategically by us, we will acquire, rehab, or construct and sell at affordable rates to qualified individuals. Let me put it simply to this. If the east side of Main Street is a opportunity zone census tract, and the west side of Main Street is not an opportunity zone census tract, why would we want to invest so much money on the east side, hold it for 10 years in anticipation of significant appreciation, and not rehab the west side of Main Street, which will only increase the value of our investments in the whole community?
That's really smart. I like that. That's very smart. Very smart approach. Yeah.
And
That's
in
great.
we're adding an economic development into that and working on a solution for funding businesses to come into. About 20 to 20% of both our funds are set aside up to for commercial, retail, and other non-residential in order to develop job opportunities in those same communities. So we think we have a complete solution for that.
Yeah, no, I like that. So how do you find, I know you're a busy guy, so I want to kind of wrap up, but I do want for our viewers to understand just a little bit. And I know it's hard because it's such a complicated thing to explain in layman's terms because there's so many moving parts, but how do you source an opportunity or a development? How do you get the work done? Where do you get the GCs and all that from? I think we got a sense of where you get the investors from. You tell them about the investment, you use your metric tool, and then I guess how do you move forward or manage that asset or then, sell it down the road in a disposition? Just give us an idea of, I know it works differently on each deal, but just give us kind of a day in the life of how you've seen it work.
Sure. Well, it takes a lot longer than a day.
Sure.
We source most of our deals from our unique public-private partnership with our not-for-profit partners.
Yep.
They are a preferred acquirer from federal and state housing agencies. So there's a very significant and very attractive deal flow pipeline that comes directly from them.
Yep.
In addition, we get calls from developers who are looking to do, some are not looking to do affordable or really social impact. We screen those out. If a developer is truly in our space, then we will begin a discussion with them on the economics and what's his plan. But the first thing we do after we've made the contact or the discussion of this project, proposed project, is we do a site visit of the community and the neighborhood. And we walk the neighborhood. We talk to stakeholders in the development. Who's going to be there? We very much like to involve local, high-profile, not-for-profits or church leaders who have leadership in the communities. They can tell us more than we can just see.
Yep.
As I said before, we're not transactionary. We take a long-term investment strategy to rebuild the entire community. So we want to meet residents, and in some cases, walk the houses, see what the houses look like. We had a very pleasant experience in looking at a neighborhood in North Camden last month, and there were flower boxes. Yes, there were homes boarded up, and yes,
Right.
there were vacant lots, and yes, there was some things that didn't look as nice as they could have. But the residents, there was a diverse base of residents. The homes that were occupied were clean. There was flower boxes. And one of the things that we were so surprised to see is that there was a local not-for-profit that was providing part-time jobs and apprenticeships to high school students in the area on carpentry, landscaping, and had attempted to fix up some of these homes. But as I mentioned when I started, simply there isn't any capital for these.
Right.
Government has a lot of tools in the toolbox that they provide. They can't execute on anything, but they provide these tools, financing incentives, tax incentives,
Sure.
things I know about. The not-for-profit sector, of which I've had a lot of experience, is a mission-driven organization, and for the most part has very technically competent management, senior management, and people committed to a goal of whatever their mission is, but they're underfunded.
Yep.
They're like a startup company that doesn't have any money.
Right.
And I've been in that situation.
Sure.
What I want to do is I want to fund these not-for-profits, create an asset class that our high net worth individuals invest, that fuel the nonprofits' ability to build affordable, quality housing and redevelopment, economic and residential, in these distressed neighborhoods. We found that in this particular neighborhood, we are dedicating ourselves to this. We will be investing in this neighborhood because it had energy. It had people who wanted to call it home, and it had a not-for-profit that would provide. We could partner with them for apprenticeships that they would bring in their young men and women and learn carpentry as they work with our builders. So that's the kind of the energy and the feeling we need that really energizes us to say, all right, we want to be here. We want to be part of this, and we want to be able to say that we had a small part in making this happen.
I love that you're doing that. I love that you're coming on a show like this to educate people, let them know that it's out there and it's a viable investment opportunity. I think that's terrific. So I'm really glad that you came on the show, and I appreciate you coming and speaking to our viewers.
Thank you so much, Michael. I can't thank you enough for giving me this opportunity to talk about what we're doing. It's new, it's different, but it's exciting, and I hope we have a lot of people join our mission.
I agree with that.
Thank you again.
Thank you. Yeah. Thank you all so much for tuning in to see Bob Hutchins, CEO of Ellavoz. Boy, that was a really informative episode. It's so great to see an organization that is targeting shared values and combining that with a level of return and investment. That is definitely what is needed. excited to have him here. I hope you all learned a lot, took some notes while he was talking, because I sure did learn a lot. So thank you all so much for tuning in to another exciting edition of Money Talks. I'm your host, Michael Thomas, signing off.